Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our Interactive Broker Studio right here in Midtown Manhattan. Cameron Kreis, Macro Man, writes at Bloomberg, like, if the economy is slowing down, someone may want to tell the consumer, because clearly retail sales didn't point to that. So I thought that was quite a good point. And you look at equities just flying higher here. Joining us now is Maury Shor, Senior Equity Analyst at Columbia Threadneedle Investments. Maury, what good news for stocks? Is that a fair statement? We get good news by the equity market.
Absolutely, yes. I think the results today show us that the consumer is more stable versus what was feared. We had heard more throughout the month of July that there was a slowdown happening. But in my view, the consumer backdrop remains stable, and the differing results that we see between different retailers just shows, who's gaining share and who's losing share. But when I looked at the trends today, I think although the high level retail sales number was better than feared, I would say when you dig a little deeper, the trends are still mixed. On the one hand, we see the consumer still choiceful in their spend, spending more on services over goods and needs over wants. At the same time, within discretionary, we do see some signs of life in categories like apparel and even electronics. So still a very mixed print, but certainly better than feared.
Back to school holidays. What are some of the retailers telling me about some of the big events coming up here for the retail sales number?
These events are very important because, as we've heard from every retailer for years now, the consumer is shopping very close to need. So, the tone from Walmart in terms of the trends they saw ending the quarter and in August to date were very positive. Again, they've seen very consistent results. I think the consumer will show up for back to school in the same way that they showed up for holiday. And again, I think we're seeing that in some of the data today with the strength in electronics and even in apparel, where there are some new trends that are resonating now.
So in the equity market then, is it difficult to pick the winners and losers? Because it does feel like it's hard to get a broad macro read. Like, the data's slowing, we know that. Check that box. But in terms of what they're buying, I would have thought the Tapestry would have struggled, right? I would say, okay, at some point, the coach passing on price increases was going to max out consumers. It doesn't look like that's actually happening. How hard is it to do your job?
It has become more challenging, especially because the markets are so volatile, right? And hedge funds and macro funds are just having such a large impact in how the stocks are trading. But we are seeing a very clear difference between share gainers and losers at this point. And so what we're really trying to do is focus on the companies that are gaining share, where we see the potential for positive earnings revisions. The problem is a lot of those stocks are screening as pretty expensive. Right. Names like Walmart and Costco. On the other hand, there are names where even with more modest revenue growth assumptions, there is a real margin and free cash flow growth story there. So that is like the other group of stocks that we are trying to focus on. But to your point, it's very hard to listen to what one company is saying and extrapolate that, because it really feels like within a kind of lackluster consumer or retail backdrop, there are still some companies, like Walmart is a perfect example, that are able to do very well right now.
Hey, Maury, what kind of deals can I get if I go shopping out there? How promotional are retailers out there these days?
Are you asking that for me?
Yes.
That's so sweet.
Yeah, I think we talked about this last time. So since the holiday season of 23, the retailers' inventory levels have been much better positioned. Not perfect, but much better positioned. So while the retailers remain aggressive on promotions to drive traffic, you're not going to see the crazy promotions that they had to run when they were heavy on inventory. And we should also see fewer markdowns, which will be very good for margin. But at the same time, everyone recognizes that the consumer is stretched. And I know both like the consumer staples companies and a lot of the retailers and brands are talking about needing to promote to drive volume and traffic.
I was reading an article the other day that retailers are already buying their inventory for the holiday, which totally makes sense. I mean, a lot of cargoes were coming into ports, et cetera. How confident do you think retailers are in their inventory buildup for the holiday?
They seem pretty confident. You know, what we've seen on the freight side is a recent rise in ocean freight rates. So that's something we've been talking to the retailers about. Right now, a lot of them are locked into their contract rates. So it doesn't sound like that is a near-term risk to margin, but definitely something we have to monitor for next year. There's also been some disruption in the Red Sea. We've heard about recent protests in Bangladesh, which could impact companies that are sourcing from there. But so far in our conversations with retailers, it doesn't really feel like any of those things are going to result in any real near-term disruption to the business. And it sounds like, you know, the outlook for a holiday in terms of getting the inventory that they want and need is pretty consistent and stable.
And Mari, when I was looking at the Walmart numbers, again, what jumps out at me as it does so many quarters is their e-commerce up 22%.
Yes.
Boy, they're right there with Walmart, aren't they? I mean, they don't take it. I mean, with Amazon, they don't take a step back from Amazon at all, do they?
Right. No, absolutely not. I mean, remember, Amazon is still clearly the dominant player in this category. I mean, overall, e-commerce is about 30% of total retail sales, and Amazon is almost half of that. So Amazon is obviously operating off a much larger base. Having said that, Walmart is now growing faster than Amazon. I think the only other company I follow that is growing at a similar rate is actually Costco. And I think what's happening specifically in the case of Walmart is a lot of their new initiatives, building out their marketplace, building out fulfillment, building out their membership model, building out advertising. All of those initiatives are finally coming together and really driving their e-commerce business. And so the thing that's so impressive about Walmart as we look at their results is it is very clear that they are gaining share across channel, across category, across income demographic. And that broad-based strength, I think, will drive strength in their results for the foreseeable future.
All right, Mari, we appreciate it. Thank you so much, Mari Shor, Senior Equity Analyst over at Columbia Threadneedle Investments, joining us from Boston, Massachusetts. And again, now I'm addicted to this ALTD Go screen. And I'm looking at sort of the estimated sales we're looking at here, and they're still beating competitors.
Yep, I know.
Anyway, ALTD Go. Really cool function on the terminal. You should definitely check it out.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get back to the story of the retail, because today's a story about the consumer. We had retail sales come in a little bit better than expected. We had Walmart report some numbers that the street liked. The stock is up. So Jen Bartashus joins us. She's Bloomberg Intelligence Retail Analyst, covering all the retail space, including Walmart. Hey, Jen, what did you take away from these Walmart numbers? The street certainly liked them.
Yeah, actually, Walmart had a great quarter. I think most people expected it because they do tend to do well when the consumer's under stress. But some of the things that were interesting takeaways were things like the amount of generative AI that they're using in their business to close the competitive gap to peers like Amazon, especially in e-commerce. The idea that their growth is being led by volume, which is a very different story than we're hearing from most retailers. And finally, one of the other remarkable things is that they sort of issued a little bit of a warning shot to packaged food companies about still wanting to try to pass through price increases, and that Walmart is really focused on bringing prices down instead.
So does that bode well? So here's what I'm trying to understand with the volume side. Does this mean that this is good news for like a Costco or Target, or is Walmart taking share from the likes of Target?
Well, I would argue that Walmart is probably taking some share, and that they're translating that into volume gains, because they're very focused on offering value, whether it's from a price perspective or from a convenience perspective, and that seems to really be resonating with consumers right now.
Are people coming down who maybe were not Walmart shoppers, but now they're coming to Walmart? Is Walmart seeing that?
They are. They talked last quarter about bringing in higher income households, and that trend seems to be continuing. In the last year and a half or so, Walmart has invested in improving and renovating their stores, which is particularly important for higher income households, because when you walk into a store and it's kind of dingy or grungy, it doesn't make for the best shopping experience. And so part of that investment is resonating with those higher income consumers, but also people are becoming more practical about where they're seeking value. And I think I've used this example before, but if you can buy a box of cereal, which is a standard box, for 15 or 20% less at Walmart than you can at your grocery store, even that speaks to higher income households that are looking to save a little bit here and there as well.
Also, just in comparison of just how expensive regular grocery stores have gotten too, just in terms of that. Also, what about their e-commerce? Because basically another perk for Walmart is they're just basically like a giant warehouse also.
Yeah, I mean, their e-commerce operations are continuing to grow. I think one of the things that investors are finding very encouraging is that the losses associated with e-commerce are narrowing. Originally, Walmart said that they actually thought that it would generally be profitable in the next year to year and a half. Now today, Doug McMillon kind of backed off and said, don't focus so much on just one metric, but that those losses are easing, and that really is a good indicator for Walmart as well with regards to its overall profit profile and where it's developing as a company.
Just real 30 seconds. Where does growth come from Walmart? Is it just a GDP top line story?
It is in part, Paul, but at the same time, they really are pulling more people into it. They're kind of with their overall ecosphere. And so it's also through variety. So it's not just the store, it's, an increasing marketplace where they're becoming more competitive with the likes of Amazon, but it's also things like financial services or vet services or things that they're exploring that help bring people in for more than just shopping.
All right. I tell everybody my next gig is I'm going to be a greeter at Walmart. I'm not kidding. Jen Bartashus, thanks so much for joining us.
I can't tell if that would be entertaining or weird.
That would be, you would love it when you walked in to see me. Wouldn't that be great?
I don't know.
Would you please how people were dressing walking into Walmart?
I'm really trying to absorb what this would look like.
All right, we're going to have more coming up. That was Jen Bartashus giving us the latest on Walmart.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio, where we bring you all the top news in business and economics and finance through our lens of our Bloomberg Intelligence folks, because they cover 2,000 companies and 130 industries worldwide. So back to that retail sales data. Good news, I guess. You look at the 2-year, though, bonds yields are up by about 12 basis points, which is a head scratcher for me because the news is good. So good news is good news. That's at least what the equity market is saying. But then the bond market, what is that telling me? Luckily, we're going to talk to Bhansali. He's founder and chief investment officer of LongTail Alpha. Hey, Veneer, are we looking at the bond and equity market telling us the same thing about retail sales right now?
I think they're slightly different. I think this has been a problem, not just this year, but for a couple of years now. I think the equity markets are being driven by a lot of forces, external investors, buybacks from large corporations, retail buying a lot of stock. The bond market is not that convinced. I think the inverted yield curve, certainly we can talk about it, is telling you a very different story. I think long-term yields are too low here, which is part of the reason why retail sales and the economy is strong and keeps getting stronger.
What do you make of a week ago Friday? That was a real shock to the marketplace, and we saw dislocations. I mean, we had the VIX, which is now below 15, was above 65. What do you make of that trading activity we saw a week ago Friday, Veneer?
Yeah, so, I wrote about this last week. What we've observed over the last few years is that the intensity at which markets are selling off and the big spikes is getting bigger and bigger. It happens over a very short period of time. And, going back to 2007, 2008, where it used to take months and quarters. Now it's just taking weeks and days and maybe hours. And last Monday was, again, you couldn't have done anything except if you did something in the pre-market. Nikkei was down 12%. We were up that night, all night. And, again, it was just an air gap. There was absolutely no liquidity. And I think that's just one of those warning shots that tells you how levered the system is and how illiquid the system is. And I don't think that was the end of it. I think even today, the massive rally we're seeing is happening on extremely thin, illiquid conditions.
I thought positioning, though, if we just stick with the bond market for a second, I thought positioning was all cleaned out now. That after the turmoil the last couple of weeks, now we have a cleaner read. Is that not the case?
I don't think so. I think what happened was people tried to get out. I mean, it's like a very big elephant trying to get through, the eye of a needle. I think some people got out maybe in panic on Monday and Tuesday, and then a lot of systematic strategies started to reverse as VIX dropped, like Paul just mentioned, from 65 pre-market to about 20. Many systematic strategies that are indexed to the volatility market have to relever, and I think that's what you're seeing today. Very illiquid, billions and billions coming back into the market, and there's really very little liquidity for them to buy the risk assets back.
Veneer, what do you think our Federal Reserve is going to do next month?
Well, I think they have to ease. Now that they've conditioned the market, they have to ease. And I think, that could be a 25. I don't think they're going to do 50. It'll be too aggressive. My sense is they're going to do a hawkish ease. They'll do 25. And like the ECB, they'll say, we'll wait and see what happens, which is exactly what they should do at this stage. And I think, that could set the stage for the next round of the carry trade unwind. I mean, it's trillions out there, trillions that have been accumulated over, 2 decades or so, because U.S. rates going down, Japanese rates going up, compresses the yield spread, meaning a stronger yen, which could generate the next round.
And so you think that we'll see a hawkish ease in September, but a hawkish ease doesn't seem to me a carry trade unwind. It would be more the more dovish they are, no?
Yeah, possibly. It depends on, again, the carry trade unwind, right? The currency markets is driven by the short rate differential, right? So U.S. rates come down 25 basis points unless the Japan has to raise another 25 basis points. That 50 basis points has a very significant magnifier effect on, things like the cost of carry and so on. And I think that's what's going to drive things in the short run. So when I say hawkish ease, I mean, they're going to ease, but then they're going to try to manage expectations for rates, call it, 2 years out or 5 years out. That this is not the beginning of a 10 ease cycle, which is typically what happened and what the market's going to try to build in right away.
Veneer, in the fixed income space, where do you see value here? Should I just stick with my 2-year Treasury north of 4% here, or should I take some credit risk?
No, I like the 2-year note. I think, Paul, the 2-year note and T-bills, just a month ago, the auction cleared at, close to 5%. So I think if you can get a, 4% yield on 2-year notes or 5.25% on T-bills without taking any risk, duration risk or credit risk, I think that's a great place to be. And talking about credit, yes, it could tighten, but I mean, it's trading at basically all-time tights right now. I mean, investment grade credit and high yield credit, you really have to bet that there is nothing on the horizon that could upset the apple cart. And I believe there's a lot out there. So you have to be careful right now.
Well, yeah, that was an interesting point, because when we saw the VIX spike, we didn't see the blowout in credit spreads in a way that one might have thought. Why do you think that was?
Yeah, I think the market was waiting, right? So we were here early in the morning, and we were watching the VIX at 65 and the VIX futures only getting up to about 30 something. And the credit market waits and sees, right? Because credit, you can think of it as a long-term put on the equity market. And the fact that the VIX came down was a breath of relief for the credit markets. Spreads did widen out, CDX spreads did widen out to about 57 or actually mid-60s from 52, 53 the week prior. But then as the VIX came down, people basically said, okay, this VIX spike is not translating into long-term equity volatility rising because the VIX curve was inverted and so on. And credit markets watched that pretty carefully. And basically that was the reason for the credit markets to kind of settle down. Again, if you believe like I do, that was only the first round, I do think you have to be careful because the next time around, if there's a big shock to the system, credit spreads could widen and stay wide, or even widen more.
Veneer, do you guys have exposure to alternative investments? Is that part of your outlook?
So we're direct investors in the market, so we don't allocate to other funds. Obviously, we're trading, all the futures and options and so on for our investors. But yes, we are looking at all the alternatives as signals on what might be happening. So you have to be pretty hooked on to what everybody else is doing in today's market.
What do you think is going to be the trade around the elections? Like, I get the Fed, we got to get through that, right? But there's got to be some political and geopolitical risk hedging that we're going to see crop up. How do you think about that, particularly when it doesn't really matter who's going to be in the White House, in that it feels like deficits are just going to be blown out no matter what?
Yeah, I think a lot of it is priced in, right? So a couple of months ago, when I was talking with some of my colleagues at Bloomberg, my view was that Mr. Trump was probably going to win. It was pretty much baked in, and then with everything that's transpired, it's a very close race, as we know. And one of the big shocks from the 2016 elections was that the market got who was going to win wrong until the Florida returns were coming in, and then second, conditional on who won, the direction of the market got completely wrong. It sold off, limit down, and then limit up. And I think that's the possibility here. So the elections could be extremely volatile. One is we don't really know who's going to win. And secondly, we don't know, conditional on who wins, what the market does. And I think that's the surprise that you've got to be prepared for. And given that, we believe there's a very good opportunity generally to be long volatility, right? Because volatility fixes back to below 16, 15 almost. It's a great time to bet on the unpriced event possibility of something that market is not discounting actually happening. One of them could be Kamala Harris wins, and instead of the market selling off, there's a massive upside rally in the market because that's really not a priced outcome in the market today.
All right, Veneer, we really appreciate it. Thank you so much. Really great to get that perspective. Very helpful. Veneer Bhansali, he's joining us, founder and Chief Investment Officer of LongTail Alpha. Don't you kind of wish if you're a market participant, you could put in a position and then go away for 8 months and then come back and see if it made money?
Well, it's called, again, investing in the S&P 500. That's why you see those index ETFs.
True.
Are just getting so much fund flows in there. Because a lot of people are saying, for most of folks out there, just buy an ETF that mimics the market and just go away. I mean, from a cost perspective and a return perspective, probably a good strategy.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's go to Deere. So I mentioned it. It's up over 6%. It wound up cutting costs, but its earnings also kind of less bad than feared. My question, though, always is if you have corn at $4 a bushel or under, which because conditions are so good for corn right now, that's going to be really tough for farmers. And then how do they go buy all the fancy equipment?
And you're right. I didn't look at corn. $4 a bushel.
Yeah. And there was a great piece, I forget where I read it, that talked about how it's actually technology and innovation that's allowing American farmers to do so well, as in have so much crops, but then that hurts on the price side. Very cyclical industry there. So Christopher Ciolino is Bloomberg Intelligence Senior U.S Machinery Analyst, and he joins us now. Give us your take on Deere earnings.
Alix, I mean, the results really weren't as bad as many had feared going into the quarter. Both from a top line perspective, margins, earnings, all kind of better than what we had expected in what is a pretty challenging environment, given the commodity price backdrop. I think one thing to take away from the quarter is that, pricing really continues to be remarkably resilient. We actually saw pricing accelerate here in the quarter in their ag businesses. And then really they kept their 2024 guidance unchanged for the most part after all their peers cut during the quarter. So while we're not quite out of the woods yet, and there's certainly more headwinds from a demand perspective moving into 2025, I think this probably just, alleviates some of the concerns over a more severe downturn in the near term.
Growing up in my lawn mowing days, I always wanted a Deere tractor, but
doesn't?
My dad would never go for it, so I had to push mow our lot, which was a little over an acre.
That's something.
That was a lot, and I'm like, for $3, by the way.
Ooh.
And I'm like, can you kick in for a Deere tractor? No, was the thing. Now, I got the Vespa scooter, so that's one of the things off my bucket list, but not the Deere tractor. I'm still working on that.
I feel like you need
And what would you do with that?
Exactly. I have
sit in it.
Sit in it, drive around town. So talk to us, Chris, about what Deere is saying about the U.S. farmer, because it just feels like that's Deere is a real proxy for the U.S. farmer.
Yeah, and certainly nothing runs like a deer, Paul. Yeah, the backdrop isn't really favorable for the farmer, at least for the balance of this year and probably into next year. Commodity prices continue to be under significant pressure. If you look at corn, soy, wheat, all down, 15, 25% plus year to date. Farm income is going to be down north of 25% this year. New and used inventories are still quite elevated. We don't have these big pricing tailwinds that we had over the last 3 years. So it's certainly a challenging market, and input costs are relatively elevated. So farmer incomes are going to be under pressure. Really the focus with Deere and really all OEMs now is really to try to kind of right size the inventory in the channel. Inventories are too high. So there's going to be a lot of focus on underproducing retail demand for the balance of this year, with the hopes of producing in line with retail demand. And then, where the retail environment shakes out for next year, it's still a little bit up in the air, but certainly from a commodity price perspective and a farm fundamental perspective, certainly no signs of a bottom yet.
Well, also I should point out too, when we say like less bad than feared, like North American sales were still down or lower by 15%, and revenue in South America down by 15 to 20%. Do we feel like this is definitely the trough though?
Yeah, I think it's a story of the nicest house on a bad block,
Yeah,
right?
exactly.
I mean, it's still a pretty difficult environment, and it's still pretty fluid. I don't have a ton of sense if we have really good visibility on a trough yet. I think that's where investors are, starting to coalesce around 2025 will be a trough earnings year. But it's still kind of a little too early, I think, to draw any conclusions. I think we'll have a better idea probably at the end of next quarter and how we exit the year in terms of an inventory perspective. And if they're able to kind of get through those inventory cuts and we're kind of more aligned with the demand environment, then I think it's even possible to see earnings growth and margin expansion, even if we're looking at a lower or slightly lower retail environment.
Chris, we heard from, Home Depot that said some of their customers were deferring big projects, waiting for interest rates to decline. And has Deere said anything about that? Like, if I'm a farmer, do I say, man, I don't need the tractor this year. Maybe I'll wait next year when maybe my financing rate will be a little bit lower?
The large ag, the large professional farmer, a little less sensitive to the interest rate narrative. It certainly has more of an impact on their small ag and turf business and utility customers. They are much more interest rate sensitive, but that market's now been weak for multiple years. So I think we're at a trough or coming into a trough on that market. And then I think, some new information that we got this quarter is that particularly on the construction side of the business, now they took down some of their numbers for the year, and actually construction was one of the disappointments in the quarter, as some of the rental fleets and construction equipment customers slowed some of their order velocity, and they pulled back on some of their capital spending. So, and the higher rates were a contributing factor to that. So I think that's where you're seeing more of the impact, less so on the large professional farmer.
I hired Ciolino out of Global Data at Bloomberg Intelligence, 12, 13 years ago. He didn't know anything. Now he's a rock star. I mean, he talks to people all over the globe. He talks to these companies. He knows what he's talking about. Chris Ciolino, one of the good ones in Bloomberg Intelligence, covering some of those industrial stuff, along with Karen Ubelhart, talking about Deere, some better than expected earnings.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So head over there and just check out Bloomberg podcast, and that's where you'll find us here. Thinking about where we were a week ago Monday, the VIX over 60, big sell-off in the markets. It's almost like, please look at the markets today. It's almost like it never happened. Are earnings that good? Is economic data that good? Let's check in with a professional. David Kudla, founder Chief Executive Officer and Chief Investment Strategist. He kind of does everything there at Mainstay Capital. He joins us from Troy, Michigan via Zoom. David, what do you make of a week ago Friday, what we saw, particularly in the morning, to what we've seen since then?
Right. Yeah. So we had that growth scare because of an ISM, poor ISM, and non-farm payrolls number 2 weeks ago, and that was aggravated by the yen carry trade issue. With a week ago, with jobless claims, we got a little bit of help there, and of course, the data today with retail sales, jobless claims a little better than expected. But I think look at the data yesterday, or let's say Tuesday through today. Tuesday, we had PPI coming in well below expectations. Yesterday, we had CPI coming in slightly below expectations. Headline inflation is below 3% for the first time in a long while. And now today, we have retail sales, kind of a blowout number when we're expecting 0.4 and get 1%. Which says the consumer is still strong. If I'm going to loosely borrow a Mark Twain quote, reports of the consumer's demise have been greatly exaggerated. Mm-hmm. We need the consumer to stay strong. It's 2/3 of our economy. They were certainly strong last month. So look what we have. We have growth with lowering inflation. I don't want to overstate it, that it's a Goldilocks economy, because we do have a real fear of recession. We need the Fed to get started on their easing cycle. And I think it'll be 25 basis points and not 50 in September that many are predicting. Mm-hmm. But they need to get going, and they have the room to do it. We're on a good glide path on inflation. And when we have growth with inflation slowing, that's a pretty good scenario for the economy.
Why are rates up then right now in that scenario you just lined up?
Yeah, well, rates are up today because the retail sales number came in so strong, right? More than double expectations. And, the growth scare of 2 weeks ago, it's really been a significant change. The comparison that Paul was talking about from 2 weeks ago to today. So, Alix, we've really seen, a terrific number that tells us the consumer is still out there buying. And that's all important, right? For the U.S. economy, the consumer is all important. It's 2/3 of consumers, 2/3 of our economy, and that was a very reassuring data point. But it means the economy is a little bit stronger than we thought. Bond yields go up 5 or 7 or 9 basis points.
So what type of stocks, what type of sectors work in an environment, David, where the economy is hanging in there, maybe slowing, but hanging in there? But we now have the prospect for lower rates. What kind of sectors screen well for you guys?
Yeah, so first of all, we like the secular growth stories like mega cap tech for a long time, and we still believe in the AI plays. But now we can look at cyclical plays. Take financials, that have struggled so much over the past years. Now we actually had the yield curve uninvert briefly last week. And we're certainly seeing a steepening of the curve. And as the Fed starts to cut rates, we'll see that steepening of the curve, which will be good for financials because NIM, net interest margin, improves. So we like financials. Mm-hmm. We've been extending bond duration. We had for over a year and probably 15 months had been in ultra short-term bonds because we just wanted to capture the yield and we didn't want the interest rate risk. And that was a good play. But now, it's time to be extending duration because we know the Fed is going to be cutting. Forecasts are still about 100 basis points by the end of the year. That's, with that easing in place, that means we want to lock in rates and extend our duration. Mm-hmm. And we also are broadening. It gives us an opportunity to broaden portfolios into small caps, values, cyclicals, mid caps. Areas that we had been mostly buoyed in favor of large cap and large cap mega tech.
But what about the idea that with small caps, the PE ratio, so the P part wound up re-rating enough that, okay, maybe you want to buy it, but maybe that thesis is out the door a bit because small caps did have a run before the growth scare, but that the E part isn't really holding up. That's what I hear a lot about the small caps naysayers.
Yeah, 42% of the small cap stocks in the Russell 2000 aren't profitable. It's a struggle. If if a small cap stock does well, it grows into the mid cap region and it leaves the Russell 2000. So here's what needs to happen for small caps is we really need what's coming, the rate cuts that are coming, avoid a recession, and the PE multiple of small caps is so attractive compared to large caps at this point. We were hitting earlier in the year historical highs, multi-year delta of PE of large caps versus small caps. So the attractiveness is there, but we need the right kind of environment. Data like today, we've seen what the Russell 2000 did today in early trading, up over 2%. And if we get the rate cuts, the economy can be slowing a bit, but no recession. That's a good environment for small caps, for value, for cyclicals.
You think the Fed is going to go 25 or 50 basis points, and do you even care?
First of all, that's a good way. That's a good way to ask that question. Do we even care? The most important thing is they get started. The first cut means they switched from a neutral stance to an easing bias, right? From neutral to easing. So the first cut is symbolic in that regard. I think that they will go 25 basis points, because if they go 50, and I know what the case is for that, for the case that others are making, but then it raises a question: Are they doing 50 because they're behind? I mean, they've still got November, December. They've still got more meetings to achieve 7,500 basis points by the end of the year. Maybe even do a half cut later. I just wouldn't start there, again, for symbolic reasons. So I think they do 25. But the part about do we even care? The main point is they get started. Let's get going, Fed. Let's get the first cut in there and establish you have changed your bias to an easing cycle.
But to that point, something that I feel like is becoming more of the conversation, I think it was Bostic that mentioned this when he was speaking to the FT, is that you had a delayed reaction and transmission mechanism of policy on the way up with rates, so why not expect that then on the way down? Which implies that we do need to see sort of a little faster, more aggressive cut so it filters through the economy a little faster. What do you think about that part?
I think that's actually, it's absolutely right. I mean, when we talk about Fed policy and the mistakes they made the mistake of 2021 of staying easy for too long. Continuing to buy mortgage-backed securities, making mortgages so attractive. People saw their house price go up 1.5 times or double in a couple of years, and they helped create the problem of inflation with the first policy here by staying easy for too long. And they probably are going, when we look back, they probably will have stayed tight for too long. 5.25 is a restrictive policy. Inflation is on a glide path to their target. It's time to get on with cutting rates. Probably should have cut 25 in hindsight. They probably should have cut 25 in July, and then they'd be ready for another 25 in September. And that's what might beg the question. They need to do 50 to get caught up. But yeah, our concern is they make the same mistake on easing as they did on easing now as they did on, they were easy for too long, went way up to, drove it up to a restrictive policy, and now they got to get on with it.
All right, David, thank you so much for joining us. Always appreciate getting your views. David Kudla, he's the founder of Mainstay Capital Management, joining us from Troy, Michigan via Zoom.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.